Friday's screen looked like money was running away from the market. The Nasdaq fell 1.4%. The S&P 500 lost 1%. And the chip sell-off spread into a broader risk-off session, with communication services and consumer discretionary among the weakest areas. But the most important question is no longer what fell. It is where the money went. The latest fund flow data gives us a more useful answer than price alone because it separates market direction from capital destination. In the week through July 15th, investors pulled a net $4.8 billion from U.S. equity funds, the first weekly withdrawal in 3 weeks, according to LSEG Lipper data reported by Reuters. Growth funds suffered $7.18 billion of outflows. At the same time, value funds attracted $3 billion, while U.S. bond funds drew $9.89 billion for their 13th straight week of inflows. That pattern does not prove every dollar leaving AI moved directly into value or bonds. These are separate fund categories, and the data cannot trace the path of the same dollar from one account to another. But it does show that investors were not rejecting every U.S. asset at once. They were reducing exposure to the most crowded growth trades while continuing to pay for cheaper equities and fixed income protection, a distinction that matters before calling this a market-wide liquidity collapse. Friday's cross-asset reaction supports that interpretation, but only conditionally. The 10-year Treasury yield slipped to 4.554%, even as Brent crude jumped 4.59% on renewed Middle East tension. Energy was the only S&P 500 sector to finish higher, while longer-duration growth stocks remained under pressure. That is not a clean inflation trade or a clean recession trade. It is a market trying to hedge two risks at the same time. Here is the confirmation framework for the next several sessions. If chips remain weak but value, defensive sectors, and treasuries continue to hold up, the better description is rotation. Leadership is changing, but liquidity is still finding a home. If value joins growth on the downside, market breadth deteriorates further, and bonds also lose support. The story becomes more dangerous. That combination would suggest de-risking is spreading beyond one crowded trade. The next watch point is not whether one AI stock bounces on Monday morning. It is whether upcoming mega-cap and semiconductor earnings can restore confidence without pulling money back out of the rest of the market. A narrow rebound led by short covering would repair price, but it would not prove durable liquidity. A broader advance with improving participation would be much stronger evidence of durable demand rather than temporary relief. The calm verdict is simple. The AI correction is real, and the pressure has broadened, but the flow data does not yet confirm a full market exit. Right now, money appears to be changing address faster than it is disappearing. Price is the surface. The destination of liquidity is the message.